Sean, I got to say, if you've been a new investor to this market, let's just say in the last 6 months, you've probably never thought the market could go down. But it does go down, does it not?
It certainly does on occasion. I think it was proof yesterday that stocks do not always go up. But I do think this is most likely profit-taking. Let's not forget the NASDAQ returned 9.6% in the month of August. We've had a really strong run. And also, like you're seeing today, maybe it's not all stocks that go down. The Dow Jones is kind of, in my view, the recovery index. So that tells me that investors are possibly still optimistic about the recovery, but they're taking some profits in some of these high-flying technology names. So I'm not sure that this is the beginning of a new bear market or anything like that. I think this is probably a healthy pause after a really strong run.
Why is this not the start of a new bear market? If you may allow me to play devil's advocate here, it sure seems like this market has been due for a pullback. I mean, the valuations are stretched. There's all kinds of, the economy may not be as stable as we think it's going to be given COVID. Why is the market now justified at these high levels, and why is this a pullback that you should buy?
Right. I actually think that the Federal Reserve and its actions, along with the fiscal stimulus we saw out of Congress, has sort of acted like a vaccine for financial markets that's actually helped it develop antibodies to risk. And if you look during the global financial crisis after 2009, the S&P 500 never corrected by more than 10%, while the Federal Reserve was expanding its balance sheet. I think the Fed is essentially doing the same thing here. I think it helps limit the downside to stocks if we do see a sell-off, particularly when you're hearing Fed speakers like Evans and Brainerd say that they think the Federal Reserve might need to take more actions in coming months. Now, I think they wait until after the election. I don't think they want to appear to be political. But I do think if you saw a really sharp sell-off, then you would probably see the Fed come in even faster.
There's been a narrative, I guess you could say, over the last several months now about this notion that the economy is not the stock market and the stock market is not the economy. But we can say that the stock market is a discounting mechanism. It takes into account the future expectations for the economy and puts a price tag on it today. That's the reason why they're at record highs, because the economy should be doing better 6 months, a year from now than it is right now. Should we be worried with the market pulling back like this that it's telling us the economy may be following suit soon?
I don't think so. And there's a few reasons I don't believe that. One, if you look at Citi's Economic Surprise Index, which tracks whether or not economic data are beating expectations or missing expectations, data are actually doing quite well. We've seen really good durable goods data. U.S. GDP for 3Q is actually tracking just shy of 30% annualized. That doesn't get us back to where we were back in the fourth quarter of 2019, but we've seen a stronger than expected recovery. And I actually think later today we're going to get the August employment report, and I think we're going to see an upside surprise there too. Citi's economists are looking for 2.1 million, which is higher than consensus. And I would not be surprised at all to see a better than expected read today.
All right, let's put a point on this, Sean, before we let you go. Given that backdrop you've just told us about, what exactly is the investment strategy? What do you buy? What do you sell? What do you hold?
Right. So at Citi Wealth Management, we're doing three things to clients right now. We're telling them three things. One, if you're not in the markets, you may want to average in just to kind of take a little bit of risk out of moving into the market. You also might want to use structured investments where you can get exposure to stocks, but they offer a degree of protection on the downside. And then you want to look for the remaining areas of value. This may not be the start of a rotation out of tech into value, but it could be. So we actually like the industrial space, consumer discretionary sectors, and then small and mid cap, not just in the U.S., but in Europe in particular and globally. So we're focused on the areas of the market that haven't fully recovered just yet, but will probably recover further along with the economy.